We remain very favorable on the economy for the foreseeable future, going through the second half of 2014 and into 2015. And what we're going to want to look at are tangible data points. So we want to look at the economic statistics within the U.S., which have continued to trend favorably, as well as U.S. Corporate earnings. We're getting into the second part of the corporate earnings, or 2Q corporate earnings, and that has remained very strong, and we continue to have a good outlook for that. So we expect modest growth for the rest of 2014 and into 2015 for the U.S. economy. As we've seen very strong high-yield markets, whether it was 2013 and into the 2014 timeframe, we've seen the trend in yields going lower as well as coupons. Now, one of the main drivers of that is a very active new issue market, which has allowed companies to issue new debt at lower coupon rates, which has been very healthy for company balance sheets, and we've seen that reflected in the high-yield market. We're very favorable on the outlook for earnings for all three asset classes. What we can point to are the fundamental drivers of all three asset classes, but more importantly, the earnings that we've seen so far. So for the first quarter of 2014, we saw very positive earnings, where 77% of companies either met or beat expectations. So far through the second quarter earnings, we've seen positive results as well, with over 73% of companies reporting better top-line results and not just meeting expectations. So we remain positive on the outlook for 2Q earnings as well as through the rest of 2014. The main driver of spreads for high-yield bonds is going to be default risk. And so when looking at the fundamentals within the high-yield asset class, default risk remains very low. So that should bode well for the spreads going forward from here. When we look at the relative value of high yield versus other fixed income asset classes, it still looks very attractive. We don't have great insight as to what interest rates are going to do going forward from here, but in a rising rate environment, we should expect that high yield will do well also relative to other fixed income asset classes. We believe the asset class remains attractive. When you think of it in the context of other fixed income alternatives, high yield should perform very well if and when rates do begin to rise. The asset class has continued to perform well, as I've said before, through 2013 and into 2014, and we don't have an expectation for default rates to increase, which would imply any depreciation in price going forward from here. It can be difficult to gauge what the absolute impacts are going to be to the U.S. economy. What we can go off of are the tangible data points that we've seen, and those have all been very positive. Across the three asset classes, high-yield bonds, convertible bonds, and equities, we've seen very strong results on a year-to-date basis, and we hope that those continue and expect that those will continue as the economy continues to improve.